She predicted the FTX blowup in 2018, and she's going to tell us what is coming next. Now, I'm talking about an interview I am having right now with a Wall Street veteran, and who predicted in 2018 in a 4-part series written on Forbes what was going to happen. Now, a small side fact is that the 4-part series she wrote in 2018 were actually the first 4 videos I made on this channel. So go back and check out the archives on that. However, she explained exactly what was going to happen, why it was going to happen, how it was going to happen, and so here it is. And as much as she predicted and as much as she got right, even I was surprised the exact reasons, the exact depth as to how big this problem has become. And she's going to tell us how this problem is being fixed, what this looks like in the future, how massive improvements are being made, both in regulations as well as technology, and what the future looks like. I'm talking about Caitlin Long. She is a Wall Street veteran. She is the CEO and founder of Custodia Bank in Wyoming. She is a wealth of information, somebody I've been looking forward to having on the show for a really long time. Super excited about this interview. You're going to love it. So let's go ahead and dig right in. All right, Caitlin, thanks so much for joining me today. You don't know, but I've been looking forward to this interview for a long time because one thing I want to talk to you about is a 4-part series that you wrote back in 2018 for Forbes, kind of forecasting what might have happened, like we just saw right now with the FTX. But what you don't know is that this YouTube channel, my YouTube channel, I started 4 years ago, and the first 4 videos I did were breaking down those 4 articles that you wrote. I did not know that. Yeah, I had been making YouTube videos before on my business channel with my old business partner. That was a crypto thing. I left the crypto thing, decided to focus on Bitcoin, and started a brand new channel. And the first 4 videos I did were those 4 videos talking about that. So anyway, it's a long time coming. Appreciate you taking the time.
Yeah, that's great. Happy to be here. Yeah, thank you. Those pieces, I've gone back and referenced them several times. It's kind of funny how it played out because it was the announcement that Bakkt, which is a sister company of the New York Stock Exchange owned by ICE, which is the largest centralized intermediary in the financial markets, that Bakkt was entering Bitcoin. And what I was doing back then was warning that Wall Street was going to come into Bitcoin and try to take it over and financialize it. And what I missed, actually, was that it wasn't the Wall Street entities. Ironically, the regulators held the Wall Street entities back. It was people from Wall Street who were Wall Street trained, like Sam Bankman-Fried, who brought their tricks of the trade into this unregulated asset class and, did some damage for sure.
Yeah. So it was very, very foretelling for sure. As I've gone back to kind of read that, preparing for this, like you said, you kind of nailed it. And I guess, you understand the financial system, and so you just realize it's just always the same game being played over and over by different players. But you talked about that Wall Street would try to co-opt cryptocurrency the only way it possibly could, which is to financialize them, which would be creating layers of debt on top of those assets. And is that basically what you think has happened with probably all the way from maybe not Terra Luna, but definitely the Celsius, Three Arrows Capital, Alameda, and FTX?
Oh, definitely. That's what all of the leveraged Bitcoin and leveraged crypto players did. FTX, I think, is just a case of good old-fashioned fraud and embezzlement, but it would appear based on what we know as of now. But the others that weren't engaging in outright fraud were engaging in these backdoor leverage practices like rehypothecation. Some were open about it, others were not. And we talked about that in those 2018 pieces, that there's some question as to whether rehypothecation is itself fraud. In fact, there was a Supreme Court case that I cited in Wyoming, and I believe it was 2016, maybe 2015, but not too long ago, that held that rehypothecation of an industrial diamond was fraud. And so what's fascinating is the securities industry rehypothecates everywhere all the time. If you look at the fine print of your brokerage account statements, it's there. The thing is, most people don't know what rehypothecation means. And so most of us, sign those brokerage account agreements. And by the way, there are no brokers that I'm aware of that don't rehypothecate. So it's just standard practice on Wall Street. And it's because of the structure of how securities are issued. And there's a long history as to why they're issued the way they're issued. We don't own the brokerage, the securities in our brokerage account, just like we don't own the dollars in our bank account. They're both legally IOUs. We've lent them to our financial institution, in this case, our broker-dealer or our bank, and then they owe those back to us. So what we own is not property. What we own is a contractual obligation, an IOU. And most folks don't understand that. But from that has stemmed a lot of shenanigans. And again, the reason why it evolved that way is because everything used to be in paper form and you couldn't do real-time gross settlement of transactions. Well, it's been years since we've had the ability to do that, and yet the financial system has stuck with these old practices. There are a lot of people who figured out how to make money off them, for sure.
Yeah, so I want to talk about that and kind of how this moves forward and new banking and what you're working on. We'll go through that. But just to kind of catch everybody up, I wasn't really aware of what rehypothecation was previous to that back in 2018, reading that. And so rehypothecation, I'll frame it up very simply, and you can correct me if I'm wrong. But if I had a candy bar and I gave it to you, you would owe me a candy bar. And you gave the candy bar to somebody else, so now somebody else owes it to you, but you also owe it to me. That person gives it to somebody else. Now they have an IOU, and they also owe it to somebody else. And that can go around 8 people think they have a candy bar, even though there's only one candy bar. That 8th person
Correct.
eats the candy bar, and now 8 candy bars disappear out of the system.
You bet. You just described it. You just nailed it. That's exactly it. And if we think back to first principles, if that candy bar is property, and if we actually recognize that candy bar as property, then we're in a completely different world, because if it's recognized as property as opposed to an IOU, a contractual right, then only one person can own that property. And this gets into the law of this is how the Wyoming digital asset custodian laws work. It's the same law that applies to it's called bailment. It applies to valet parking for your car or for coat check. When you hand over your coat at a coat check, you are not giving them physical title to your coat. You're just giving them temporary possession of it for safekeeping, but you are the legal owner of it. Same thing with a car. What happens on Wall Street when you park your car at the proverbial garage, they turn around, take it out for a joyride, lend it out to an Uber driver and pocket the earnings. And then when you come to get your car back, they might give you the same make and model as opposed to your actual car. So a lot of people have figured out how to arbitrage, these systems. And unfortunately, we had a lot of those folks who, especially, there was an interesting observation by Isabella Kaminska that a lot of the worst blowups in crypto came from traders who were trained in trading ETFs and trading derivatives on Wall Street. And boy, that's true. If you look at some of the worst blowups, it's traders who came from that world. And again, as I look back on the 2018 pieces, that's what I missed. I thought that the big institutions would pull it off. No, it was their regulators who held them back. What happened is that the people said, well, forget it, I'll just go offshore and start exchanges that offer 125 to 1 leveraged futures contracts on Bitcoin. And guess what? Some of those folks made a killing. But and I've said before, those leveraged perpetual futures contracts that were 125 to 1 leverage, where the onshore futures exchanges only ever offered you about 2.5 to 1 leverage, just to give you a sense of how far out of whack it was. Those 125 to 1 leverage contracts had 99% house odds. And this is what I've said before, that the 1950s Vegas mobsters would have blushed. They would have loved to have been crypto, futures exchange entrepreneurs offshore in the last bull market. And what's funny, actually, about how it all transpired at FTX is that in spite of having 99% house odds on some of the contracts that FTX was offering, it still went bust.
So the rehypothecation is taking the asset, lending it back out. And so thereby you're kind of creating more of that asset in the candy bar example. I've loaned one candy bar, but now 8 candy bars come into existence. So through that way, Bitcoin, which is capped at 21 million, could potentially have more Bitcoin because of that paper market. That's basically
Correct.
what we're seeing with that, right? Also,
yes, absolutely.
Also through these leverage exchanges, if I can trade Bitcoin at a 2x or 5x or 100x, I'm also adding more Bitcoin into the ecosystem as well.
Yeah, that's correct. It's a little more subtle with the futures exchanges if they're running a completely offset book. So if someone buys a contract and there's a separate seller of the contract, then the exchange is neutral. But here's the problem. One of the issues is that we know these exchanges were not neutral. They were rolling the dice themselves, which is how, FTX, despite having 99% house odds, still went bust, right? They were leveraging things up themselves. And one of the problems with rehypothecation is that it basically just builds a Ponzi-like industry, right? And I want to make it clear, none of what I'm about to say has any application to Bitcoin itself. Bitcoin itself is immune to all of these dynamics in its secondary market. And another thing that I like to say is I think price is the least interesting aspect of Bitcoin. I also like to give a nod to Nick Szabo's speech at Bitcoin 2021, where he said liquidity in Bitcoin markets is a nice to have, but it's not a must have. And what he means by that is, all these traders brought all this liquidity in and brought the bid offer spread for transacting in Bitcoin way down. But you don't need narrow bid offer spreads. You just need to be able to transact when you need to transact. And whether the spread is 1 basis point or 1% or even 5% really shouldn't be relevant to you, because if you're using Bitcoin as an insurance policy, what matters most is that you can transact. And if all these leverage players come in and all they do is bring down the bid offer spread, who's benefiting from that? It's just them. It's not regular folks like us who don't transact very often in our Bitcoin.
Isn't that sort of like a spectrum, though? Because they bring all that liquidity, they bring the bid offer spread down, but there's more liquidity. They could get out of there, which would then have less liquidity, which would bring that bid offer spread up. And to your point, who cares if it's 0.1% or 1%? But if it goes too far, then there's no liquidity and I can't get in and out, which if I need to get out, then I'd have a problem.
Well, that's exactly Nick's point, is that you do need to have a market. You need to be able to transact, but whether you pay high transaction fees isn't the point of Bitcoin. And so it's also interesting because it's not a zero-sum game. So you asked earlier about the futures exchanges, where if the futures exchange is offering a long contract and a short contract, and they're just sitting in between capturing a fee and they're not taking a directional bet, then that is neutral. However, what we also know is that a lot of this is not neutral, and rehypothecation, setting aside that futures example, is never neutral, ever. And here's why. Because anytime you're artificially creating increased supply of something, anytime any supply increase happens, if you think back to your supply-demand curves that you might have studied in your first economics class, anytime you push that supply curve out to the right, the price drops. Okay, so in this case, what's happening is that people are thinking they're buying real Bitcoin. And in fact, actually what they're buying is the Bitcoin IOU from an intermediary. And if the intermediaries are running naked, in other words, they're selling more Bitcoin than they actually own, which we know definitively has happened in every single one of these examples of companies that went bust this year, then what it means is that they've reduced the price. Okay, so the long holders, the hodlers like us, have had our pockets picked because the price at which Bitcoin transacts in the secondary market has been artificially suppressed. Now, there's a tweet storm that I did with a friend of mine who sent me a quote from Hayek that said, it's more than just that the price is suppressed by the increased supply. It's also that the demand dynamic is altered by rehypothecation as well, and these kinds of similar things: naked shorting, fractional reserve banking, essentially some of the things that ETF market makers are able to do, where they mint more units of an ETF than the actual underlying that they have in inventory. Any of those kinds of shenanigans has both a supply and demand impact. And why is it that the demand impact? This was a light bulb moment for me, and I sent out a tweet storm that got several thousand people engaging back in December 2021, so a year ago. Here's the answer. It increases demand because people think that they're getting the real thing and they're not. And so the demand for the real thing actually goes down. So there's a double whammy. The price goes down because the supply curve has been shifted out to the right, which drops the price, all else equal. But also there's less demand for the real thing, which also drops the price. Now, what's the impact of all this long term? There's going to be one hell of a short squeeze in Bitcoin at some point. And it could not be during our lifetimes. It could be tomorrow. We don't know. It's going to take a long time. But if you play this game out, eventually there's a point at which there's literally nobody willing to sell Bitcoin because there's nobody, there's no price at which letting go of any of the Bitcoin that we hold makes sense for us. And I'm not saying it's permanent, because back to your question, you do need a market. And this is what Nick Szabo's point was. Of course you need a market. This is money. You need to be able to transact in it. But liquidity, meaning that there's virtually no bid offer spread, is not the point of this. You just need to be able to transact one time when you need it. And I don't think that idea of Bitcoin going no offer, where there's literally nobody selling, is a permanent thing. I think that's going to be essentially the ultimate short squeeze. Trace Mayer and I talked about this a lot. Many of you have studied his 7 network effects of Bitcoin. And the 6th network effect is financialization. And he and I debated this. He was more favorable about financialization than I was, because I knew what it was going to mean. It was going to suppress the price, and it was going to clip the top of the bull market. This is one of the reasons why some of the models, like the stock to flow model, didn't work as well in this bull market, because we had so much more leverage and rehypothecation sitting on the price, and therefore clipping the top of the bull market off, which is exactly what happened. And by the way, it swings it more on the downside as well, which is why we pierced the previous trend of higher highs in each of the 4-year bull market cycles for Bitcoin. We never pierced higher lows. Each of the lows was higher in the successive bull market or bear markets, but this time, no, we pierced the bottom. Why did we pierce the bottom? Because all that leverage unwind creates downside volatility. So you get the worst of both worlds. People are skimming value off the secondary market by engaging in these games, and the real owners are having our pockets picked. But as Trace and I debated this, he said, hey, at the end of the day, what it really means, if Wall Street wants to do these games and they know full well that they're not going to win, maybe they'll win in the short term, but they're not going to win in the long term, because nobody's ever going to bail them out when they go bust. Okay. And this is a feature, not a flaw, in my mind. So what does it mean? It means that the hodlers are going to be able to stack sats at lower prices. So the way that you can take advantage of this situation, which just is, whether we like it or not, it is. The way that you can take advantage of it is to, buy the dips, so to speak. I'm not making recommendations. I'm not making any trading calls here. Just talking you through the theory of, if these prices are artificially influenced by all this leverage, which we know they have been, then you can take advantage of that as long as you understand it.
Yeah. And going back to the statement you made earlier about price being the least important or least interesting thing here, which I like to say all the time as well. When you look at new technologies like an Uber that was, pitched in Silicon Valley a decade ago, that price doesn't go mark to market daily for a decade maybe, right? And so you're not witnessing it in real time. And so with Bitcoin, we are witnessing it in real time. But even though Facebook stock is down as much as Bitcoin today, the Facebook network is still working perfectly fine. And Bitcoin is down like Facebook, 75% today. However, it's still censorship resistant, still immutable, still permissionless. And so the network is still working fine as well.
Still adding blocks every 10 minutes or so. Exactly. Yeah. And the Lightning Network is finally scaling it. I am so bullish on the prospects for Lightning finally scaling Bitcoin. And ironically, also, as Elizabeth Stark said at the African Bitcoin conference, it's actually Bitcoinizing fiat currencies. That's going to blow people's minds if you haven't dug into Lightning and understand what that means. How is it that it makes Bitcoin an intermediary currency for fiat currency to fiat currency foreign exchange transactions? They'll get routed through Bitcoin using the Lightning Network payment channel routing technology, with Bitcoin being the intermediary currency. And unless you're an engineer or a Bitcoiner who's really dug into the Lightning Network, you wouldn't even know that Bitcoin was behind the scenes, the intermediary currency. And there were just examples of folks who were in the markets in Ghana sending US dollars to themselves, 20 US dollars, and within 2 minutes they had the Ghanaian currency. And that, most people don't understand that that's a big important aspect. And finally, we have the ability to have not just internet native Bitcoin payments at scale. Of course, that's a redundant term. Bitcoin is, of course, internet native, but we now have the ability to do internet native dollars and euros and yen using Bitcoin as the back end technology. And I think that's a killer app for adoption. And most people who end up using it over time will never know that Bitcoin is running behind the scenes.
Yeah, that's sort of like I think Jack Mallers talked about that at Bitcoin 2022, where basically, it travels along the Bitcoin rail and it converts to whatever in fiat currency you want at the end, I guess, something like that.
You've got to have those endpoints, which is what I know we're going to talk about next, is the fiat currency on-off ramps, the gateways, which are the entry points and the exit points. You definitely need a network that has those points in order to scale it. But what I'm seeing with Lightning Network, you've seen me, I had the little lightning emoji on my my Twitter for, I don't know, a year and a half or two now, after the lightning torch and then feeding the chickens, right? This is how it all got started.
That was fun.
And now it's really finally starting to scale. The average payment, I think, I saw $42 going over the Lightning Network. But as the network effects exponentially arrive for Lightning Network, the average payment size starts to increase. And basically, this is really only limited by the networking architecture, the infrastructure, in terms of how fast payments can move. And it used to be a couple years ago that half of the Lightning payments would fail because the routing technology, there just weren't enough players in the network, but it's exponentially growing now. And now I think I saw Swan put out a statistic that 98.5% of Lightning payments are now going through essentially at the speed of light and essentially free. This is quantum change, folks. It's really exciting, and almost nobody's talking about it. And obviously, Twitter has already integrated Lightning payments. Elon keeps teasing that Twitter's going to be made into a global payments platform to be able to move fiat currency. And he's going to be using crypto. He's confirmed he's going to be using crypto. He hasn't said which protocol he's going to be using, but of course, Bitcoin and Lightning are already there. So he could flip a switch if he wanted to and turn that on.
Well, we would hope, we'll cross our fingers and hope that his, maybe he'll lean into Jack Dorsey, the previous CEO of Twitter, and bring some of that Bitcoin Lightning in. However, bringing CZ and Binance on board makes me think it could go the opposite way. So we'll have to see how that plays out.
Yeah.
Yeah.
CZ is not, when he invested in Twitter, he made it clear that it's a relatively small position, and I don't think he's going to be in a position to influence the decision about which crypto protocol gets implemented. But I take your point. Elon himself is not a Bitcoiner, but all that integration work, which, as you know, is not easy to do, and all the work that Jack did with Cash App when he was still at Twitter, it's already there. And so all Elon has to do, since it's already done, is just start talking about it. And the moment he starts talking about it, the network use grows up exponentially. One more quick thought before we move to the next topic. This is such a threat to the banking industry. Okay, and frankly to central banks too, because fiat currencies can move over the Lightning Network, never ever touching a bank. And that's the first time that's ever happened. Now, up until now, I mean, you can look at it and say, well, gee, the Lightning Network, I think the white paper came out in 2016. So it's been several years in the making, but it's finally starting to scale, right? And so when all these things were there, they were very small, nobody paid attention. It's once they start to scale that the regulators start to pay attention. And so what's happening now, I think there's a race between the technology companies and the banks to implement these new technologies. And if the technology companies get durable network effects, and I would include Twitter in that group, if they get durable network effects on these internet native fiat currency protocols, wow, that's a big challenge to the banking system, and as we know, the banking system is itself highly levered. Over time, I've been making the statement for several years now that over time the banking industry is going to have to deleverage itself, and it has a lot since 2008, and I think it will even more, just simply because the velocity of transactions is going to speed up. It's exactly what we're talking about. If you're now moving US dollar payments at the speed of light, you can't very easily have the old business model of borrowing short and lending long, right? Taking demand deposits and turning around and making a 30-year mortgage with it. That old business model isn't going to fly in a world where everything suddenly starts to settle at essentially the speed of light or something close to it.
Yeah. So let's jump into banking. There's a lot to talk about banking. I want to talk about, obviously, you're starting your own bank, Custodia, right? So you're the founder and CEO of Custodia. You got it right there. So I want to so you're in the thick of this. And I want to talk about kind of what the purpose of banking is and what that purpose is kind of moving forward. I want to talk about some of these changes coming to banking as you're talking about, but but what maybe holds that back, regulations, things like that. So let's talk about that for a minute. So you're creating a new bank. I believe you're creating the bank to be like a Bitcoin and like a full reserve bank versus like a fractional reserve bank, which we don't even really have fractional reserve anymore, right? There's just no reserve banking anymore. So talk about, I guess, your new vision of the bank, and then we'll, I guess, go from there.
Right. Well, first of all, on your last statement, yes, it's true that there's no reserve banking, but what happened is the bank regulators moved off reserve requirements and put higher capital requirements in their place. So it's a misnomer to say that there's no reserve requirement, because the reserves and the capital are actually pretty much fungible, and there's still a very high capital requirement. In fact, there's some argument, and I would agree, that those capital requirements should be going up for especially the very large, globally systemically important banks. They're way too leveraged, and I've said that for years too. But so back on why is banking important, right? Some Bitcoiners are probably thinking, my God, this is like fingers on a chalkboard. Wait a minute, we're supposed to be able to be our own banks. Why are we bothering? And why have Caitlin, spent 3 years banging my head against the wall trying to get one started? Yeah. And the answer is because of exactly what we talked about earlier in two aspects. Those gateways between the fiat currency and Bitcoin are really important. And then also the fact that you're just going to see a speed up in settlement of payments is going to fundamentally change the banking industry. And that was already coming even before Bitcoin was created. So let's start with that second point first. I alluded to it already, that we're now being able to move US dollars at the speed of light. And so what that means is that banks that play these historical games of borrowing short and lending long, taking credit risk, taking interest rate risk, doing maturity transformation, all those things are inherently coming under pressure. And that started before crypto, and it was inevitable. FedNow is going to be coming online next year. And FedNow is the Fed's real-time gross settlement system. We don't know very much about the details of it. We do know that they're going to cap it initially at $100,000. So big wholesale payments, B2B payments, are really not going to be impacted by this yet. And so it's a little bit of a race, again, between the technology companies who have these internet native US dollar and other fiat currency capabilities now versus the banking system, which is running on very old technology. Yeah. The ACH payment system is 1970s payment system technology, right? So the banking system is very far behind on payment technology. And now here comes, these networks that anybody can join within the span of a couple hours to sync your node, and it costs you $100 in hardware to become a node on the Bitcoin network, and anybody in the world can do that. So it's pretty clear that the banks were going to be coming under pressure anyway. But so why would I start a bank? It's the gateway. Getting back to that first point, I don't think we're going to have hyper Bitcoinization in a short period of time. And in fact, actually, if we do, God help us, because we're not ready. We don't have the infrastructure yet. Much as the hardcore Bitcoiners among us really wish the fiat currency system would just collapse and go away, I don't, because I fear the social unrest that would come from that. And I'll give you an example of what can happen when you try to force something before the infrastructure is ready. One of my relatives came up to Wyoming from Denver for Thanksgiving. That's a 90-minute drive. We're basically in southeastern Wyoming. We're the outer reaches of Metro Denver now. 90-minute drive. And the reason that I highlight that is they had just bought an electric vehicle, all electric vehicle. And they checked to be sure that there was a supercharger. And guess what? The supercharger was out of order when they got here, and they needed to charge their car. It took them 14 hours on a trickle charge to get enough charge to be able to do a 90-minute drive. Okay, so we just don't have the infrastructure yet.
How about a better example? We can look at Germany. Let's just shut down all our nuclear reactors when we have no other fuel sources, energy sources. So plenty of examples. Yeah.
There you go. Right. If you try to force this too soon before the infrastructure is built, then you really have you can walk into chaos. And I don't think that that's a good idea. That the deflationary impacts on regular folks it would just be devastating. And so I think what we need to do as an industry is just keep building the infrastructure, keep our eye on the ball, keep building the user experience. As I said earlier, I think people will ultimately use the Lightning Network without even realizing that they're touching Bitcoin, or that their transaction rather is touching Bitcoin. We need that user experience to be that seamless, and it's not there yet. We've got a lot of work to do as an industry. It's going to take a few more years, but in the meantime, these gateways, the dollar and digital asset banks, data banks, we're calling ourselves, DADA, data banks. We are critical infrastructure for this industry, because you need to be able to get in and out of the fiat currencies. And right now, let's face it, as much as a lot of us are hardcore Bitcoiners, myself included, I still am doing most of my transactions in fact, really all in fiat currency, right? And look at the stablecoin demand. It's 99.5% dollars.
Yeah. So, but if we look at, I was just thinking, like, what is the purpose of a bank, right? And so the purpose of the bank was to look after my deposits instead of burying my gold in the dirt back, in some field that's not very efficient. So they can look after my deposits. They can handle my payments, receiving payments and sending payments out, and then, interest and loans. And so if I'm able to now,
some combination,
right? But if I don't need anyone to look after my deposit, I don't need anyone to handle an incoming or outgoing payment, then do we really need the bank? Now, I understand what you're saying. Obviously, that's a different system, and there's no way to easily get from this system to that system. And so, yes, we're still in a fiat world, and I agree we probably will be for some time. And so maybe the bank really kind of facilitates that exchange. Maybe they're like money exchangers more than actually like payment, depositors and payment processors. They're more like kind of like money changers.
Well, money warehouses, so custodians, right? If you think back to how banks evolved back when when money was physical gold. So in the U.S. in the mid 1800s, the money warehouses. Now this is before wildcat banking came along. One of the problems, as we have just seen in the crypto industry, is that some of the worst elements, the greediest criminal elements of society, come in and try to take advantage of that. And we saw that for sure with the wildcat banks. But we have much better ability today to ensure that there isn't information asymmetry like there was back then. You didn't know if your money warehouse that was storing your gold was solvent. We definitely have, with things like proof of reserves and audits and information availability due to the internet, we have better ability, if we know what we're looking for, to demand that kind of solvency proof from our financial institutions. It's incredible that people just willingly, blindly put money into these offshore crypto exchanges without having any insight into whether they were solvent or not. They were just chasing yield. And it wasn't even offshore, right? Think about Celsius and BlockFi, right? These were operating onshore as well and trying to pay these juicy yields. And I was warning folks at the time, you don't know whether those juicy yields are going to cover your counterparty credit risk. And it turns out that in the end, they did not. And so, 19, 20% yields weren't enough. But yeah, so, and then definitely the payment systems. I still think we'll always have banks to provide custody, safekeeping services, as well as payment services, and basically it's the user experience. It's the UX, right? It's always still going to be software. Bitcoin and Lightning, the base level protocols, very few people actually use those unless they're engineers and are trained or have spent a lot of time figuring things out, right? How many people early, before we had some of the Bitcoin improvement protocols, to be able to create the seed recovery phrases. Well, now we can memorize the seed recovery phrases, but in the early days of Bitcoin, that wasn't how your private keys were best stored. And then, think about the hardware wallets and things that have been designed since then to be able to take advantage of just easier user experience in storing your private keys, but it's still very engineering intensive. And if you're going to use the base layer protocols, and most people won't. It's just like how many people use the command line interface to make a call from their mobile phones. Right. Well, if you're an engineer, you know how to do that using voice over internet protocol, but most people actually still pay a cell phone provider to provide a better user experience for them. Yeah. And I think that will always be how it is in money. People, when money really is 100% software, it's not right now. Mostly it's analog still. People talk about digital payments. They're not digital because they're not natively digital. You've got to have an internet native token like Bitcoin in order to have a truly internet native payment system. All we've done with digitization so far, both in banking and securities, is to digitize analog units of money. Some things that used to be paper, and all we did was basically, PDF them or create them in a spreadsheet-like ledger database. But that's actually quite different than what Bitcoin is, where something's digitally native. It's internet native. Right. It never has been in analog form, and it never has to be. And so therefore the software providers are always, I think, going to be critical to the ecosystem.
Yeah, and I would just point out for people listening too, I think you have to understand that different people have different needs. And so if you're an individual user, you might be able to just custody it yourself, set up a multi-sig wallet, no problem. But if you're a small business, a large business, a Fortune 500 business, you can't just set up a multi-sig wallet and just do it like that. And so you're going to have different types of features. And so there probably always will be these types of service and providers, kind of like what you're talking about.
Exactly. Yep.
So, okay, so this bank of the future, that's more of this data warehouse that's kind of managing some of these features. we're always going to keep running into the same problem, which is kind of, as you said, even back to the wildcatters, and probably since the blacksmiths, the money changers in 2,000 years ago, always is going to want to try to get more, something for nothing. And so we're always going to kind of keep running into the same problem, right? Human nature of wanting to rehypothecate it, of wanting to, inflate it, things like that. So how does that get prevented other than having an army of regulators that can't seem to do their job anyway?
Well, we talked about it a little bit before. We've now got the advantage of things like cryptographic proofs of reserve and audits, and then the internet allows information to travel very far, near instantly. And so the information asymmetry problem, we have the tools to solve it now. But you're absolutely right. It is human nature, unfortunately, that some of the basest elements, the worst elements, because this is money, as Willie Horton used to say, why did he rob banks? Because that's where the money was. Right. That it is gonna attract the worst elements. So regulations can be part of that, and I'm not afraid of the regulations as long as they respect property rights. If we get back to the property rights respecting approach to regulation, boy, that solves an awful lot of problems, as opposed to what we have now, which is all these IOUs, and people can pile IOUs on top of IOUs. So I'm okay with that. And
is Custodia kind of setting up and kind of maybe building those features in kind of first? So you're like, hey, we're going to set up ways to get this communication to you, ways that you can see your money is sitting in your account over here, things like that. Is that part of what your kind of vision and roadmap is?
Yes, absolutely. The challenge, though, is you can't cryptographically prove the liabilities. Jesse Powell and Nick Carter have been absolutely right about that. Proof of reserves just tells you that you've got the private key control of the Bitcoins that you list as assets on your books, but the offsetting liability is something that can't be cryptographically proven, especially if it's in fiat currency. Mm-hmm. So you are, and Jameson Lopp has made this point as well, you are always ultimately relying on some degree of audit. When you're dealing with a centralized intermediary, if you're dealing with Bitcoin, with protocol level Bitcoin, or the base layer Bitcoin, or like Lightning or Liquid, which pegs to the base layer, those second layer protocols or side chains that are anchored to base layer Bitcoin, you don't need an auditor anymore. But again, most of us won't use those because it's still pretty sophisticated engineering to actively use those. And so the trust problem for intermediaries is a big one. Now, Wyoming, the state of Wyoming, created a new type of financial institution that is designed to be 100% reserved, both on custody and on the US dollar piece. A big part of the reason that it's designed to be 100% reserve and non-lending on the US dollar piece is exactly what we've witnessed this year, that when you've seen collapses of digital asset protocols, so think about the Terra Luna, think about HUSD, a stable coin, both of those, when they collapsed, the final collapse happened within the span of 6 hours. Okay, so right. If you're going to have a financial institution that's handling digital assets of any type, because they move so fast, what you really need is the ability for that financial institution to survive an intraday bank run. And right now, I don't think there are any banks in the United States that could survive a 100% withdrawal of all their deposits within the 6 hour period of time.
Of course not.
And so
I can't even get 5,000 out if I go.
Yeah,
if I go to a local bank, I can't even get 5,000. Yeah.
Correct. Well, the banks will let you, if you try to withdraw all the money from your account, they'll let you take $10,000 in cash typically, and then they'll ask you for instructions to send the remaining amount. And then they don't have to send that until next day. So these are some of the breaks that are, we think, again, these are demand deposits. They're really not. Right. The settlement of US dollars right now is typically, at best, it's in hours. At more likely, it's in days. So even a demand account, if you withdraw all your money from the bank, you're not going to get it for typically at least a day. But the next piece is that here comes digital assets that, in the case of Bitcoin, you get legal final settlement, well, really protocol final settlement in 10 minutes, right? And so this is my point. The banks have to be prepared to literally have 100% withdrawal in the span of a few hours and survive it. And that's exactly what the Wyoming special purpose depository institutions are designed to do. They're not designed to be lenders. Now, that said, I'm not like some of the hardcore anti-debt folks that are in our community. I definitely make the distinction between leverage that is backed by prior savings. This is the distinction between commodity credit and circulation credit. Commodity credit is if you have prior savings that have accumulated, you absolutely can and should lend that out if you're not living on it for consumption right now and earn interest on it. However, the moment you lever up more than 1-to-1, now you get into these rehypothecated claims, right? And so as long as there's no more than 1-to-1 leverage on Bitcoin, that debt is fine. It's good because it helps to reallocate capital to the highest and best use. So what would if we were redesigning a financial system from scratch, now that we have these internet native fiat currencies, or of course, internet native tokens like Bitcoin, what would it look like? The answer is you'd still have lenders. Absolutely. You should still have lenders, but you would actually have them fully funded by savings as opposed to fully funded by debt. And you would match the maturity. I've always said one of the interesting mistakes that got made in the design of the US financial system is that pension funds, which are the long-term holders of assets, they should be making long-term loans. But in fact, what we have is banks that borrow short-term making the long-term loans, and then having the pension funds not be allowed to do that kind of long-term lending. It's a mismatch. And if we were designing it from scratch, we would get rid of ERISA, we would change the inherent maturity transformation, which creates financial system stability within the banking system. We really don't need that. If we were to design it from scratch, we could have maturity matching done by the long-term investors who are the long-term lenders, and then the short-term investors are the short-term lenders. It could be done if market forces were allowed to take over, but of course, there's so much, to use the tech phrase, tech debt in our system right now, that the transition has to be done very carefully. And I think it will be done with people voting with their feet. This gets back to, why did Custodia start a bank? Because we need that transition to be done carefully so that we don't end up with the German nuclear problem, or my relative's electric vehicle problem, where we just don't have the infrastructure ready when it all arrives.
So what you just said, I would take that and we'll transition into the last piece here. You said if we were allowed. And so you've mentioned several times about this, this being just software protocol and information banks and these types of things. And so we've seen software eating the world, so to speak, and we saw how quickly music became digitized and books and movies and all those things became digitized. And if you remember, as I'm sure you do, most people remember, the music labels and the movie companies, they fought this tooth and nail. I mean, they put up a fight, but it didn't matter at the end, right? A technology that's 10,000 times better is just going to win.
Right.
And so we saw music, movies, all those things just boom, become cameras, videos, pictures, et cetera, all that became digitized. However, the financial system has all these gates built up around it, all these regulations that want to clamp down on it. And so what you just said, if allowed. And so I know you've been in the trenches, you've been fighting these, working with these regulators, fighting with them. We just saw this bill pop up, the Digital Asset Anti-Money Laundering Act, which is not maybe a brand new law. It seems like it just kind of keeps popping back up to the surface over and over. But this looks like it is. So there's two things. One, the existing process that we have right now is so entrenched. They don't want to, we have all these gatekeepers, rent seekers. They don't want to give up on that system for any number of reasons. And then we also have the onslaught of new bills coming in that could even stop it in its tracks. So like this Digital Asset Money Laundering Act, if it goes through as is, I mean, this could be a massive, massive blow to the development of these new technologies. And so I believe we have the technology in front of us to massively, a 10x improvement of all these things, as you do as well. But will we be allowed?
Well, that's what I'm working on. I have been working on it really since.
And you wouldn't be working on it if you didn't think we could.
2018. Yeah, absolutely. I mean, it's and we don't know how the story is going to be told. It's way too late to ban these protocols. So this whole that bill that you're talking about, first of all, it's not going to pass. Second of all, if it did, it will fail under First Amendment challenges, almost certainly. So, but that doesn't mean that sand can't be thrown in the wheels in the next few years by Washington and having a big overreaction to the fraud. There's nothing about digital assets that brought FTX down. It now appears it was as the receiver, who's now acting as CEO, said, this was a fraud from the very beginning. And I was aware of some things. I became aware of some things long before the collapse that made me fairly certain that was indeed the case. And in fact, actually, you and I were talking before we started the show. My debate with Sam Bankman-Fried at Bitcoin 2021. That was we continued it backstage afterwards, where I was laying out for him essentially, your business is going to fail, saying it with a smile on my face, but and maybe not quite so blunt and not quite so personalized. But we continued that debate afterwards, and you know what happened after that? He stayed away from me. The same thing happened with Bernie Madoff, right? The people who were on to the fraudsters, who the fraudsters thought might be more likely to figure them out, they stayed as far away as they possibly could. And so I was watching and saw a number of things. There were so many red flags there, folks. And there were a number of us in this industry who were calling that out as well. That, we got problems, and some of these organizations are just bad business models, and others of them are just outright fraud, right? You have to be careful. You can't accuse someone of that, otherwise they'll turn around and sue you for defamation, for example. And but boy, a number of people in our industry, hats off to them, actually came right out and said it. This thing's a fraud, and they were proven right. So let's remember, though, back on the legislation. Yes, I think there will be attempts to come in with regulation that's too heavy-handed, but we also recognize that the tech companies are putting a very interesting limiter on that. And that is that if the regulation is too heavy-handed and financial institutions like Custodia are not allowed to offer the bridges that we need to build in order to have a smooth transition to these new technologies, and it all happens in the tech industry, well, that ushers in a faster reduction in the deposit base of the traditional banking system, and that's deflationary, right? And so I think the regulators need to tread very carefully here, because they definitely need to bring these technologies into the banking system in order to keep it relevant over time. But by the same token, if they don't, and they make it too difficult or the expense is too high for regulated financial institutions to adopt these technologies as payment rails, then the tech industry will just eat the banking industry's lunch. And so it's interesting. I just saw, before we started filming this, the Bank for International Settlements did indeed confirm that they are allowing up to 2% of banks' balance sheets to be invested in digital assets. I haven't had a chance to review the details, but that's significant. We are getting positive movement in spite of the FTX debacle, or possibly even because of it. Because now everyone understands, in each of the previous Bitcoin 4-year cycles, the outright scammers and criminals created fractional reserve institutions that were built on foundations of sand. And I'm referring to Mt. Gox, which collapsed in 2014, and then 4 years later, Quadriga, 2018, and then 2022, the slew of them that just collapsed. This happens again and again every 4 years. And in the next bull market, which if past is prologue, and I believe it will be because these 4-year cycles are fundamental, if past is prologue, we'll be in a bull market again in a couple of years, and then we'll start the cycle all over again. And the sad thing is that more people will be sucked in, and with each of these 4-year cycles, the audacity of the scams has gotten worse. So I am not one who's afraid of the regulation as long as it's not too heavy-handed. And as long as it understands that if they come down like a ton of bricks, all it's going to do is push all the activity into the unregulated tech companies, and they're going to eat the banking industry's lunch. So I'm hoping that this comes out to be a property rights respecting regulatory regime.
Yeah. The one thing I was talking about on my radio show yesterday, some of these bills, and the one is from the CFTC, the Digital Commodities Consumer Protection Act. And, the CFTC wants more power so they can have, more regulation. And they said, was it Senator Booker said, had the bill already been law, it might have helped to avoid the FTX debacle. And
I'm sure it would have been. Yes.
Well, I mean, really, though, because he broke a bunch of laws, 8 counts he got charged with. We have laws. We have regulators. Right. He broke laws. It didn't stop him from doing that, right? And so, a law doesn't prevent someone. There should be a high enough penalty that it deters most people. But we already had laws. He already broke them. We didn't need new regulations necessarily. And I was just thinking, and you correct me if I'm wrong, but somehow he managed to get the only digital asset derivatives license from Ledger, which was granted by the CFTC, and they didn't do any. But they didn't do any due diligence. Hey, do you have a bank account? There was no due diligence done in order to grant that.
Yeah, I don't know what happened there. I suspect there will be an investigation. How is it possible? Yeah. But as I looked at the situation, I believe that FTX US had audited financial statements. How they got the auditor to agree to that, I don't know. But one of the big challenges is with a global complex organization like that, is if the auditor is only auditing one piece of it, they're not really getting the real story. And so the fact that the VC investors and it would appear potentially the regulators weren't asking for audited financials for the entirety of the group FTX, that's a problem, because not only did they not exist, they couldn't have been produced, because we now know it was a fraud. But back on your question, would the FTX debacle have been prevented had it been an onshore company subject to those regulations? Yes, I think it would have been. But the fact that it wasn't onshore is there's red flag number one. And then red flag number two, to your point, do we really need the heavy-handed regulation? What if we actually just gave the depositors a property right in their financial asset? Wow, that would change a lot of things. Pretty simple, pretty fundamental. Hard for anyone to argue that when you park your car at a valet parking garage, that you keep title to that asset. And if the garage goes bankrupt, you can just walk right in, get your key, and drive your car away, okay? Because that garage did not own your car. I don't think anybody would argue over any of that. And yet, when it comes to the financial system, we've got it all backwards. And we have an opportunity to create new types of institutions that actually reflect the technology itself, which is designed fundamentally to respect property rights. Very simple. So do we need the complexity of these 800-page bills? No. But do we need something that protects property rights? Yes, absolutely.
Yeah. Well, well said. We covered a lot of ground. I appreciate all the time that you've given me today. A lot to think about. And a lot to be excited about in the future. I love the fact that you're so excited about Lightning, as am I. I still hear these 2017 arguments about how Bitcoin can't scale, and I'm like, have you not turned on the computer or something? But anyway,
go research.
Yeah, exactly. Go research. But anyway, wealth of information. Check her out on Twitter at @CaitlinLong_. We'll go ahead and make sure to link it in the show notes down below. Follow what she's doing with Custodia Bank. I think it could change the future. I'm definitely paying attention. Anything else you want to shout out, Caitlin?
No, in fact, actually, for the show notes, why don't I get you links to the tweet storms from December 2021 about the impact of supply-demand dynamics of rehypothecation and how it suppresses the price. I think that has stood the test of time pretty well.
Yeah, those just popped up on your Twitter feed, right? I saw that. I didn't see something until now.
Yes, that's exactly right. Yep.
I'll make sure to link that.
Yep.
On there.
I love it when folks dig up the old stories like you did those Forbes pieces from almost 5 years ago now. And that tweet storm, these are first principles. The reason why they've stood the test of time pretty well is because it's basic stuff. It's first principles. And if you understand the first principles, for example, property rights financial regulation, those kinds of things, it stands the test of time, and it doesn't get too bogged down by the minutia. And just, I'll close by saying I lost money in Mt. Gox. I've never been afraid to admit that. It was the cheapest tuition that I have ever paid because I stuck with Bitcoin, having lost money in Mt. Gox, having had pretty much all my Bitcoins at the time tied up in there. And I taught myself how to self-custody. And back then it was not as easy. And so I would encourage folks to just, the best investment you can make is an investment in yourself, an investment in your knowledge, and just roll up sleeves and dig in on how to self-custody your Bitcoin. January 3rd is Proof of Keys Day. This is the day when everyone in our industry tries to encourage all the new folks who have come in to learn self-custody and get your coins off exchanges. But moreover, I would also add a second piece of homework that I recommend coming into the holiday season. Dig into the Lightning Network. Boy, is that scaling faster than stablecoins. It's not all visible because a lot of the payment channels, especially for the big providers, are not publicly disclosed. There's a lot more going on than is publicly disclosed in the Lightning Network, and it's really exciting.
Yeah. All right, Caitlin, thanks so much. I appreciate all your time.
Thanks much.
All right, that's a wrap. Hopefully you enjoyed this conversation with Caitlin Long. She is a wealth of information. I highly recommend giving her a follow. We linked all her stuff down below, her Twitter, the Twitter thread she talked about, and so much other stuff. You go ahead and check it out down below. As always, give me a thumbs up on this video if you liked it. If you don't, you can give me a thumbs down. That's okay. But please, at least leave me a comment and tell me what you think. Tell me why. As always, hit that subscribe button so you get notified when I put new videos out. And that's what I got. To your success. I'm out.